this is a remote broadcast. I am in a library. I'm actually in a library at my church. I'm here this morning. Tomorrow we're putting on a Thanksgiving dinner for a little over 200 people. So I've been here this morning and then just taking a break from getting the turkeys ready and getting them in the roasters to do the class. We're going to keep things pretty short this morning. I'm sure most of you are out and getting ready to batten down the hatches for our first snow event of the year. So that's coming up, especially for those of you in the southern tier. It looks like it's going to be a little bit more. That being said, what better thing to do than to get to do your EG tax midterm for the class, okay? After we're done today, I have an email ready to go. I'll be sending out the written and the computer portion. They both cover only the material through chapter 12, so it shouldn't be too bad for everybody. The problem's pretty straightforward. It's a very typical to what we would see as a regular, probably 80% of the time, tax returns that we do in the offices. And then the written is a multiple choice matching and my least favorite, but attesting true false questions. The instructions are in the email as to how to submit those, okay? So we'll have that. Just going to do a little bit on chapter 12 right now, okay? So in your textbooks, if you go to chapter 12, okay, it's part 2 on itemized deductions. It talks about casualty theft losses, net operating losses, business expenses, work-related expenses, miscellaneous deductions, and some other miscellaneous deductions that don't have a limit to the 2%. Okay. Basically, the big thing starting out is that we're going to identify each of these and where they go. We still are working on the Schedule A. The Schedule A is where we itemize deductions. Remember, we talked originally about the standard deduction versus the itemized. Right now, we've covered medical. We've covered some of the interest and taxes paid, and those things that are charitable contributions. And so we'll get into the bottom half of the Schedule A. Okay. The first section talks about casualty theft and losses. There's a lot of material in here, a lot of things that deal with different things that you can put on your itemized deductions should you have one of these events. The biggest thing to come away with this is that casualty theft and losses are only things that you can claim that were unreimbursed, okay? So if you have something that happens to your home as a loss, if the insurance covers it, you do not get to claim that, okay? So anything over and above insurance, you do get to put on there as a loss. We don't see many of these. Often the only instances come up, I have a few that maybe is somebody that had a house fire and in their garage they had some business, say they were doing landscaping and they had some mowers for their business. Those things would not be covered typically by their homeowner's insurance. So those were things were considered losses because they did not have them insured in a business. So, you know, businesses need to have separate insurance for their assets. The other thing to remember with this, with casualty theft and losses, is there's the $100 rule. And the big one is that in order to put this on your itemized deductions, it needs to exceed 10% of your adjusted gross income, okay? Very tough threshold to get over. We saw that 10% threshold with our medical expenses, so it's a very tough one to get over, okay? So that's a big one that you want to just take away from that. Talks a lot about different things that you can do. Talks about theft. You know, if somebody has, you know, we don't see this often, but back in the day with the Great Depression or the run on the savings and loans, you could do things if you have loss on deposits where a bank closes, okay? So proof of loss, again, records, okay? For anybody that has things in their home that may be valuables or collectibles that are not maybe covered by their homeowners or are something that should be on a rider on an insurance policy, make sure that you have inventory of those so that you can prove that. Okay. All right. The big section that I want to cover today, whoops, while we're there, okay, those are things that talk about the deduction limit rules for personal use and employee property, okay, and then when to deduct those losses. All right. The big thing that I wanted to cover today, get down here a few pages. Okay, is the business expenses. Okay, this is a section where somebody that is a W-2 employee can take their expenses for things that they may incur from their job. Okay, a lot of times we think of it as expenses writing off. Most of the time, the other ones that we're going to talk about is somebody that is self-employed. Okay, so when you're self-employed, you have a Schedule C because your income does not come to you on a paycheck with withholding on it. In this case, if somebody is a W-2 employee and they have a job that requires them to do things outside of what they would normally do for their job that they are not reimbursed for, then these things can be written off on their itemized deductions should you itemize. Okay. The big thing that's introduced here is things that are ordinary and necessary. Okay. You can deduct travel, entertainment, gifts, transportation, things like that, but they must be ordinary expense as is common and accepted in a trade or business. And necessary expense is one that is helpful and appropriate for the business. The example I always use, if you are a lumberjack, okay, things that you do that relate to being a lumberjack are ordinary expenses. Okay, they're accepted in that trade or business. All right. Being a lumberjack and writing off your cupcake business does not apply. Okay. Same thing for necessary expense is one that is helpful and appropriate for the business. Buying an axe as a lumberjack, that's appropriate. Okay. Buying a cupcake pan for a lumberjack and writing it off is probably not an appropriate thing for the business. Right. So again, only unreimbursed expenses. Okay. Travel expenses. A lot of times people that have jobs that require them to travel. If you have somebody that is a traveling salesman as a W-2, they might be reimbursed for their mileage because that's considered part of their job. However, some people are not reimbursed the full 57.5 cents a mile. So you can put on your taxes. So say that you're only getting 40 cents a mile from your employer. Well, that additional 17.5 cents for those miles that you drive for your job can be put on your itemized deductions. Okay. Now, the one caveat, and we'll talk about it here in a second, is relating to where that driving is done. Okay, it cannot be commuting and convey back and forth from your job. However, if you drive to your original place of work and then they send you out, a good example might be a VNA. Okay, a visiting nurse goes to her main place of employment where they give her assignments or her supplies for the day, and if they do not reimburse her for miles, once she leaves there and goes to each of her jobs, she can write those miles off. Okay. And it talks here, again, that's kind of what I was referring to as your tax home. It's your regular main place of business that you have regardless of where your main home is. Okay. Meals, deducting meals. The IRS has determined that human beings need to eat. Okay, so in job related, any meals that you have when you're out at work, you cannot deduct. However, if you have a business meeting where you meet with somebody, a cup of coffee at Tim Hortons, you buy their coffee and their bagel, you can take half of it. Okay, so you can take half of that for them for that meals. Okay, all right. Talks about here about travel expenses you can deduct and things that you can do. When you see lodging on there, okay, what that means is lodging typically is for somebody that travels for business and if they're not reimbursed. Again, most people when they travel for business are not reimbursed, okay? There is one that is that you'll come into with business expenses. that would be for over-the-road truckers. They do have a per diem. The per diem is based on the number of days that they are out away from their main tax home and on the road. Even if they drive a tractor trailer that has a sleeper on it, they do get a per diem. Okay. There's a table that you can find in the IRS publications that show for each city what that per diem is. If you have an over-the-road trucker that drives all over the continental United States, that can be very involved trying to figure out, looking at their logbooks, what each of the days may be and where they were. There is a simplified method. It's called a high-low method. And for every day that that over-the-road trucker is out, they get $63 on their business expenses. Okay? So they would have that. Okay? Gift expenses. If you are somebody, and obviously when somebody sees this, this is where it comes to mind, and you wonder why you only get a $25 gift card from somebody you work for. Well, this is the reason, because they can write that off up to $25 per person per year as gifts. Okay? So if anything goes over that, they cannot include that. Okay? Here's the chart I was referring to. Okay? This is where, if you have a home and you drive back and forth to your regular job, that is not deductible. Okay? Now, if you have a temporary work location, say that you are a TV repairman, you drive, you get your assignment, and then when you go out to the different spots to repair TVs and your employer does not reimburse you for miles, you can deduct those. Or if somebody has a second job, driving to their second job from their main job. Okay? If I work at EG Tax and that's my main job, then I work nights at Tim Hortons. When I'm driving from my regular or main job to Tim Hortons, I can deduct that. However, I cannot deduct from my second job to go home. The IRS, again, just as they've determined that you need to eat, they've decided that you need to go home. So they do not allow you to deduct that. Okay? This little chart is a great thing to keep in mind when somebody wants to deduct miles based on their job. You basically have to look at this and say, where did you start? Where did you go? After you got there, where else did you go? And where did you go from there to go home? Okay? So it's a great little chart to have access to. All right? Car expenses. Some people feel that it's more beneficial to deduct actual miles. We'll talk about this more when we get to Schedule C and self-employment. However, 90% of the time, it is much more beneficial to deduct the standard rate, okay, 57.5 cents in 2015. If somebody wants to do actual expenses, that means every gallon of gas, every oil change, registration, all the different things that they can do that would be actual expenses on the car. You can see down here actual expenses, depreciation, license, lease payments, registrations. Even when you add those up, chances are you're not going to get to 57.5 cents a mile, unless you have a car that is a lot more to maintain. I have a feeling, though, if somebody has a car like that, they're probably not using it for business because it's not reliable. So again, it's probably best that you do the mileage rate on that. Okay, record keeping. Okay, obviously you need to keep very good records to support what you would do for business. A lot of times, if there's things that you are not reimbursed for or partial reimbursement, your employer is probably going to have you do an expense report. As far as mileage for somebody to keep track of it, I don't need somebody to have a pocket spiral notebook and write down the odometer every time they go somewhere. Okay? What I require my clients is that I would like them to have a calendar. They can print one off the internet with all the months. They just need to tell me where they were each day and where they started from. And then we can always go to Google Maps and determine the mileage that they drove on each of those days. A lot of times people have, like a visiting nurse, you know, for several months, they may be going to the same location. So it's very easy to determine their miles on that. Okay? Obviously, receipts for anything else. Now, reporting on the Schedule A. I'm going to go to a Schedule A here. And give me just a second. Okay. On the Schedule A, like I said, we're down here in the job expenses. Line 21 is where we just talked about unreimbursed employee expenses. Okay. Job travel, union dues, everything like that. Inside here, when you go into the little square, is a link to forms, the 2106 and the 2106 EZ. Okay, we're going to talk about the 2106 EZ first, just because it has some great little instructions at the top. You can use this form if you are an employee deducting ordinary and necessary. You do not get reimbursed from your employer for any expenses, and you're using the standard mileage rate for your vehicles. So those are things that make it the EZ form, okay? Using the 2106, whether it be that one or the EZ, really the big thing is you want to use this if you're traveling, okay? We'll talk about other places to put things like union dues and such. But vehicle miles, this is when you want to work on this, because down below it has your little mileage that will transfer up to the top line on line 1. So when you complete line 8, 7 through 11, you can it'll automatically transfer up to line 1, and you can do your parking and toll. Okay. So, and then it has a line for anything that is business expenses not included in those other lines. Here's the one if you have an over-the-road trucker, okay, that they're not reimbursed. You can see that they get 80% of whatever that per diem is. So if it's $63 for the high-low method, you can put that in here for them on that calculation. Okay. Now, on the Schedule A, again, we'll use the 2106 or 2106 EZ. EZ if we're not reimbursed for mileage, okay? If we're partially reimbursed for mileage, we can use the 2106, okay? The other place that we can go is right here where it says type, okay? If we go into that, we can see that we get a little Schedule line 21 business expense. This is where I could list things. I could put things in there like my union dues, okay? If I am a construction worker and I have safety clothes, okay, I could put those in there, okay? So those are things that can go into that category. Since we're not doing any mileage, I just have these expenses, we want to use that on our Schedule A, okay? Now, the other thing that could end up in here is for teachers, okay? If we have teachers, they get the $250 adjustment to income that we'll cover next week. But this one is also for a spot where teachers that have over the $250 of classroom expenses. Typically, they would be reimbursed, okay? I have an individual that is a client of mine that is a science teacher. He buys the specimens for dissection on his own. So he is not reimbursed for the school district for that. So we put that on there. I have another individual that's a teacher that does the music and drama for a school district. Very small budget. When they go to put on musicals, she typically buys the supplies for the sceneries and the costume out of her pocket so that the students can put on the production. Again, those are things that are expenses related directly to their jobs. Okay. The next category you see down here is tax prep fees. Okay, whatever you paid for your previous year. Other expenses, okay? So we're going to go back to our okay. There on the bottom of page 1228 is a great little thing that I was talking about. Things that could go on line 21 that do not require you to form 2106. Those are all the different things that could be on there, subjects that we kind of talked about. Okay. Okay. There are some expenses that we can deduct for education. Again, read through these. It has to be things that you do for your job. We talked about tax expenses. Okay. All right. And those are things that can go on there. Other expenses can include that are subject on this line that can go in this category are things that you use to produce or collect income, to manage or conserve property held for producing income, and determine, contest, pay, or claim any tax refund. Again, you see most of these have related to that you can write them off if it has something to do with income that is on the tax return. Okay. Best example here is legal expenses. All right. So it must be incurred attempting to produce or collect income or a tax refund. Best example is alimony. Okay. If I hire a lawyer in a divorce, only what I pay to collect alimony is something I can deduct. I cannot pay them for doing the divorce, but if it's a portion that I may be collecting for alimony, I can do that. We can put safe deposit boxes on there. You see here hobby expenses. That is something on the hobby expenses that we talked about with hobby income that was on line 21 under other income. Okay, all right. Now, we do have miscellaneous deductions that are not subject to 2%. Okay, what I mean by that is, let me get back to the tax form here. Okay. Oops. Okay, if you look at this category, when it's all said and done, we get a total. Okay, as you can see here, we can get the total. Then we take our adjusted gross income, multiply it by 2%. Okay, if this line 24 is greater than line 26, we get to deduct. Anything over that 2%, we can count on itemized. Okay, most of the time, people do not reach the 2%, even with their union dues and tax prep and any other investment expenses or anything that they have. They just don't get to that 2%. So there's a 2% threshold, just like we talked earlier about the 10% threshold for the casualty losses. Okay. At the bottom, we have other deductions. This is where when we do a W-2G for gambling winnings, that's on line 21 of the 1040, at the bottom of that W-2G, there's an area where we put losses equal to, it can only be equal to the winnings. That is where this will carry over onto line 28. Other things that we can put on there is offset payments for Social Security or benefits. So there's things that we can put in there for the losses. Okay. All right, so you can see there gambling losses. Okay. K1, we'll talk about that when we get to Schedule E's, but those would flow over to those. Okay. But the big one we see on that one that's not subject to the 2% is the gambling loss. Okay. Here are things that are not deductible expenses on our itemized deductions. Adoptions, obviously we talked about that. That is on the adoption credits. Okay. Club dues, fines and penalties, funeral expenses. We talked about when you have your 1098 for your home, for your mortgage, sometimes in escrow you have homeowner's insurance. You do not get to deduct that. Okay? As far as investments, to attend seminars, to understand your investments is not an investment expense. The investment expense would be on your brokerage statement. You might have something where you get charged per transaction. So if you're a Scott trader and you're getting charged $7 every time you do a transaction, and you're kind of a day trader that you trade, buy and sell on your own, or if you're charged by your broker, those are things you can put on there, but not seminars. Okay. Professional accreditation fees. Again, we talked a little bit about expenses for education. Okay. If you need to have continuing education hours to maintain your level of job, that's kind of your accreditation. Okay. So again, read through the section on the education as far as what relates. Again, at the bottom here, there's a great example. Carrie had paid her lawyer in the amounts of in 2015. These are what she paid And you can see that they could designate $2,500 as deductible because it was an assistance obtaining alimony. Representing her for a divorce, that fee does not count. Okay? All right? Okay, so that's everything that's on there. All right? Now, limit on itemized deductions. Now, this is probably one not many of us are going to ever run into ourselves or ever see, but if you're married filing joint, you're limited to $309,000 of itemized deductions. If you're single, $154,000. Very rarely do I see anybody in excess of $40,000 to $50,000 of itemized deductions. Your income has to be very high, obviously. If you're showing itemized deductions for somebody that's making $100,000 and they have itemized deductions of $258,000, it doesn't make sense because there's got to be income that's allowing you to itemize these deductions. Okay? So those are on there. All right. Okay. All right. So that's the summary at the bottom regarding the other half of itemized deductions. So we've basically gone through about 2/3 to 3/4 of the tax return. We're going to start in the second half. We'll be covering some more unique, specialized things. The second half of the class where we'll get into self-employment and the business on a Schedule C. We'll get into Schedule E's for those that have rental property, things that we see quite often. So those things will start to come into play there. And then we'll do a little bit on healthcare, okay? As I said, adjustments to income will be next week. I'll have you work on that and everything there, okay? All right. Homework's been coming in from everybody. Great. I appreciate that. Everybody looks good on it. I realize it's a self-study program. Really, this midterm is the big checkpoint for us to see how everybody's doing. The midterm is going to be sent out. It is a take-home, obviously, open book. I'm not going to require you to sign in and watch you do any of this, but I'm going to send out an email that will have the outline of the procedure for the midterm. There is a written portion of the midterm, and there is a computer portion, okay? As far as the written portion, like I said, you'll just answer the questions there. You can put them just in the body of the email like you've done for the quizzes. The computer portion, you will do a tax return, and I will have you turn that in, okay? As I said, this is the big one that I need to have everybody turn in to have it done, okay? All right, so I have everybody muted right now, so if anybody has any questions, let me know.
Tim, you know I got a question.
Sure.
You know what? I was just noticing when we were doing the tax returns that, you know, in the books, that all the 1099-Rs, and I'm thinking it might be for a fact, they never seem to have the New York State information filled in down the bottom. And in real life, it always seems like I've always seen that filled in down on the bottom, you know? Is that just kind of to give us a feel for the fact that it doesn't go on, you know, it's not taxable on New York State?
Yeah.
Is that why it's like that?
Yeah, typically the 1099-Rs that you see most of the time are going to be for somebody that has reached their 59.5 birthday. So they are excluded, just as you said, each person on the return gets $20,000 exclusion on New York. So very rarely will anybody have any New York State withholding. Some people used to do it. It's always good to double check. You know, that's great that you're looking down there because that's a good habit to get into. But yeah, most of the time, just because of what we see typically is that, you know, there's no state withholding because it is usually not taxable income in New York.
Right. So even though the income is there, by checking those boxes, either 1 or 2, depending on what's appropriate for the person, assuming they're, you know, whatever for the exclusion,
Yes.
It'll put it onto the part of the New York State return where it shows that it's added into the federal AGI, but then it gets subtracted out of the New York State, right?
Yep, on that on the NY 201 the IT 201 that you see there on that subtraction section, you'll see the calculation and you know, that's why those boxes are
Okay.
there, so that it carries over for you.
Okay. And the other thing, you know, obviously I was ripping my hair out over that general rule thing. There is nothing on TaxWise to figure the initial, you know, like if somebody came in, it was their first year getting their pension and the taxable portion wasn't figured, and for some reason we did have to do the general rule thing. Well, we would for the federal general rule, we'd have to do that manually. Is that the deal?
Yeah, the simplified method's down at the bottom.
Right, that works for subsequent years, right?
Yep. Yeah, typically,
Yeah.
you know, when somebody comes in an instance like that, their first year receiving their pension, a lot of times the statements, or they'll come in prior to that for consultation, and you'll see, you know, a lot of our clients that are new retirees will come in with their whole benefit program just for us to look over, because they have questions, just as you stated earlier, about what do I do for withholding, because they
Right.
get form and stuff like that. So we'll see a lot of that prior to when they come in that first time with the 1099-R. But yes, it's always a good idea to have that original benefit statement that they received, as far as what their pension is going to be, so that you have to use the general rule. Yes.
Yeah, the magic question. Any chance you brought a copy of your tax return with you?
Yeah.
That would really save a yeah, really. Please, you can only hope, huh? Hey,
Well, you know,
in all the snow that's coming, I don't know how much you guys are gonna get, but you know, I
yeah.
try to think about it.
Well, the thing is, you know, with those, after 2008, when all the, you know, everybody got in so much trouble about their reporting and bookkeeping, as far as especially things that had to do with people's IRAs, 401ks, and pensions, the documents
Right.
are a lot more accurate than they used to be. So the general rule doesn't come into play a lot. Sometimes the simplified one will come into for somebody that has been a long time retiree, and, you know, it's never been a taxable amount on there. But the statements are getting a lot better. You know, back in 2000, what was it, 12, 13, when they started doing the more detail on the 1099-Bs for cost basis, and even 1099-Rs became much more accurate, so you didn't have to go research and try to calculate things.
Yeah. Thank you. That was neat.
So, okay. Any other questions?
Yeah, Tim, this is Monica.
Yeah, go ahead, Monica.
I was working on exercise F, 11F.
Okay.
And how do you determine, if determined, instead of the standard tax deduction, it took the general sales tax?
Yep. Let me show you that. I'm going to go to, I'll go to TaxWise and I'll show you that. Okay.
Okay.
Just a second here. Okay. So you're talking about, whoops, too far. Right here on 5, A and B, correct?
Yeah.
Okay. Income tax, that is the tax that's been withheld from your paychecks. Okay. Basically, that's
Right.
that income tax, or if you paid a tax bill in New York State from the previous year, you would add that in there. Okay. General sales tax, you're comparing whichever is the greater of the two. You can see here in this one, I have a little example, and I'm going to go into it. I'm going to use my little sales tax worksheet. Okay. What you do in that is, don't worry about the top. You don't ever use that. Okay. Down here, you put your state in. Okay.
Mm-hmm.
You would answer questions. We're always, you know, and it's in there in the textbook, but always use the letter B for us. You're going to have a local sales tax. In this case, I was doing one for Erie County because it's 4% state and 4% county. And that calculates two things. And then when you add those together, you get to take your sales tax. If that amount is greater than the taxes withheld from your paycheck, then you use that. Okay. Typically, where we would see the sales tax be greater than the income tax is kind of what Liz was just talking about. If I have a retiree that is still itemizing because they maybe still have a mortgage or they give a lot to the church, it may be the case that their sales tax, or that, excuse me, that their income tax, they don't have any state income tax withheld from any of their resource or sources of income. So sales tax is perfect. And then you can see there's a motor vehicle section on 8. So anything that's motorized, you can write off the sales tax. So if they bought a new car, or they bought a camper to go on vacation, or they decided for retirement they're going to buy a boat, Or for those of us that have the disposable income, buy a plane, okay? So you can put that in there, and then you take that as the sales tax, okay? So if I have in here that I bought a car and I had $1,500 in sales tax, I get to add that to that, see where I entered that in there? And if I go back to my
Add this,
display, okay?
add this to what?
Okay, so on the
What you,
yep, see it automatically calculated. This 856 is basically on my household's income. That's what they think I paid in sales tax through the year. I added my sales tax for the car that I bought. So this is the total sales tax that I spent. It's just kind of a simplified calculation. If you go back, now you can see my income tax, my sales tax is greater. So I'm going to use that instead of my income tax. Okay. If you have somebody that is a shoe, I call them a shoebox returner. If they come in with their shoebox full of actual receipts, you can add up all the sales tax they paid and put it on that line too. So if somebody keeps every single receipt to show that they paid sales tax buying different things, you can add it up and put it right on there. Okay? Does that make sense?
yeah, it's, okay.
Yeah, you don't see it. The only time the sales tax, like I said, really comes into play is if you have a retiree that still itemizes, because usually they don't have any state tax withheld from any of their retirement, or you have somebody that has pretty low withholding, but they have a year where they bought a new car or something motorized like that, and so they have a lot of sales tax that they spend. Now, if you lease a car, you do not get to take the sales tax because it's not really yours, and typically the tax is broken up in the lease payments over the life of the lease. Okay?
I have an additional question with what you're doing there. Under enter the local general sales tax, you have 4.0 when you said you were doing Erie County. Wouldn't that be 4.75?
Oh, I'm sorry. I meant to say Niagara County.
Oh, Niagara County.
Yep.
And,
so yeah, you're correct. If you're in Erie County, yes, it's 4.75.
okay. And where, if you're doing someone's taxes from some county that you're not familiar with it, where do you find these rates?
You'd probably have to go to tax.ny.gov and look up the ones. You know, they have on there, there's a sales tax that they show the local and state tables. Usually where I find it, I have there because I do some sales tax for some people that have self-employment. So I have the actual where you submit to the state your reports for your quarterly sales tax payments. So it's on for every single county that you can find in there. So, but yeah, if you go to tax.ny.gov and just put in sales tax rates, it'll pop up a little table for you by county.
I have a couple of other questions, if that's okay.
Sure.
On the Chapter 10 quiz, question number 10, it reads, the taxpayer may not make a contribution to an IRA if he or she has reached the age of by such and so at the end of the year. The reading says 70 and a half, but the key says 65. What's right?
Well, it depends, okay? Because, you know, typically once you reach 65, you know, the retirement, if there's no earned income, then the contributions can be limited. But 70 and a half is really what would be the best answer there, because what happens when you turn 70 and a half? You got RMDs. So
Yeah.
you can't take it out and put it back in. The government doesn't like that.
Okay, so the answer key should have said 70 and a half.
Yeah, that's the better answer, yes.
Okay.
There's too many variables in the 65 and a half. The best answer would be 70 and a half.
Okay, and in Chapter 11, on page 1140, for charitable giving, there was a section on giving property that has increased in value and likewise decreased in value. Can you explain that a little bit? Because it confused me.
Well, that's where you're talking about somebody that has something to do with basis, okay? What they're basically doing is say that somebody has decided that, you know, they're going to give their stock or they're going to give a residence or something to the church. That's where you would have to take, and you can only take off of, you know, the basis that you have and the increased value to calculate what is actually be able to be deducted. So, you know, that's basically what they're looking for. It's going back to the capital gains section, you know, where you have to go and calculate what the true value of that you're contributing. You know, you can't just contribute the whole thing because of the basis method.
Tim, this
Yeah.
is Monica. On that example 11F again, on the charitable, according to the answer, $320 going to Goodwill was not cash. How would I tell that? Because it didn't say that in the problem.
Well, typically when you're giving to Goodwill, you're probably giving goods. You know,
Okay.
contributions would be check or cash, and non-cash would be, you know, that's where you're donating goods.
Okay, that would be like Salvation Army or
St. Vincent de
or-
Paul, anything like that.
okay.
Okay.
I have an additional question on Chapter 11's quiz.
Okay.
Question 2 says Amy paid her mother's hospital bill. Her mother is not her dependent. Amy can deduct the hospital bill as a medical expense on her return because she paid it on behalf of a family member. How did they determine that, and what part of the reading goes over that? Because that was confusing.
Yeah, they can, immediate family like that, if you're paying medical bills. Some of it you have to go find basically in the publication. It's not really, I don't think, if I remember right, it's not directly outlined in the textbook. I went through that with my in-class stuff because I had referred them to the quick finder that are in the offices, but it's in the publication too that, you know, if you're paying medical bills for a family member, a blood family member, you can write that off as medical expenses that you paid. The textbook doesn't do a real good job of describing that verbatim. It just, that is true that she can do that.
Based on what, though?
As far as?
As long as it's a blood relative?
Yeah, it has to be a relative. Okay.
Okay.
If I've decided to be a good neighbor and my neighbor Ron, you know, has trouble with his medical bills and I decide to pay it for him, I can't deduct that. I can do it for a relative, but not just because I'm a good Samaritan to a neighbor.
Okay. And one last question: the midterm, when is all that due?
It's going to be due Tuesday.
Tuesday.
Yep.
Okay.
All right. Like I said, I have the email sitting right here on the computer in front of me. It's going out to everybody. It's not bad. It's not bad. The take-home written part, like I said, it's all open book, all the resources, and you can even phone a friend. I put on there so you can text or phone me if you get stuck on something. The way I do the midterm for my in-class is, you know, they kind of get it done. If you want to get it done before that time and send it to me, I usually sit down to grade the exam in the classroom for the in-class, and then what I'll do is say, I think you need to go take a look, or did you remember to, and some things, because, you know, whatever they may have done, and it's kind of their get out of jail free card, and then you can resubmit after that. Because it's no different in the office, that if you're working in an office doing a return, you know, you always got that extra preparer, that supervisor there that, you know, you can ask questions. You know, even in the office I'm at with Esther, you know, we're asking questions back and forth of each other, just kind of on scenarios, thinking about things and having to research stuff. So, you know, use all your resources. Okay. Any other questions?